Have you seen the latest numbers? The U.S. national debt has now exceeded $34 trillion. That's not just a headline, it's more than 120% of the country's entire economic output. To put it plainly, the United States owes more money than it makes in a year, and major institutions are starting to react. Moody's, one of the top credit rating agencies, recently downgraded the U.S. credit outlook. That move signals growing concern, not just from politicians and economists, but from global markets as well. The question is, what does this actually mean for you? And should you be concerned? Here's what's really happening. Whenever the government spends more than it earns through taxes, it borrows to cover the gap. That's done by issuing treasury bonds. Investors, ranging from foreign governments to pension funds, buy them, trusting the U.S. will repay its obligations with interest. That system has long been considered stable, but now the scale of borrowing has reached levels we've not seen outside of wartime. And here's the key issue: the cost of servicing that debt, just paying the interest, is skyrocketing. In 2024 alone, interest payments crossed $1 trillion. That's more than the U.S. spends on national defense or any single federal program outside of Social Security. And yes, it directly affects ordinary people. The more the government borrows, the more it competes with businesses and individuals for capital. That puts upward pressure on interest rates. So if you've noticed your mortgage rates, credit card interest, or loan costs rising, this is part of the reason why. There's also the longer-term impact. A larger share of future tax revenues will go toward interest payments rather than public services. This increases the likelihood of either higher taxes, spending cuts, or both. Now, to be fair, the U.S. has carried high debt levels before. In World War II, debt to GDP also climbed over 100%. But after the war, the economy experienced rapid growth, which allowed that debt to shrink relative to GDP. The difference today is that economic growth is not keeping pace with borrowing. And unlike in 2008 or 2020, there is no financial crisis or global pandemic driving emergency spending. This time, debt is rising during relative stability, and that's raising eyebrows. For investors, the implications are significant. If confidence in U.S. fiscal management declines, we may begin to see capital flow into alternative stores of value: gold, cryptocurrencies, or foreign assets. And if bond markets start demanding higher yields to offset perceived risk, the Federal Reserve may be forced to maintain elevated interest rates longer than expected. This affects corporate growth, stock market performance, and even retirement portfolios. So, what can you do? First, be informed. These macroeconomic trends shape the environment every investor operates in. Second, ensure your portfolio is diversified across different asset classes. Third, keep a close eye on fiscal and monetary policy, not just headlines, but the long-term trajectory. Understanding the debt situation isn't just about politics, it's about positioning yourself wisely in a changing financial landscape. If you found this breakdown valuable, consider subscribing. In the next video, we'll explain how the Federal Reserve truly controls the economy and why understanding its strategy could give you an edge as an investor. Thanks for watching.